Thought leadership from PwC's National Office.
Hello, and welcome back to PwC's Accounting Podcast. I'm Heather Horn. Today, we're continuing our SEC Focus series with a discussion on revenue, another top SEC comment letter area in 2025. Revenue is the top line on the income statement for a reason. It's closely watched by investors and by the SEC staff. From variable consideration to disaggregated disclosures, we'll walk through common areas of comment and offer practical advice for preparers. Our guests today are Mike Coleman and Ryan Spencer, both partners in PwC National Office with deep experience in this area. And joining them once again today as our guest host is Kyle Moffitt, PwC's National Office Professional Practice Leader. With that, let's get today's episode started.
Welcome back to the show, everyone. I'm your host, Kyle Moffitt, and today we're diving into a topic that's getting a lot of attention across corporate reporting and accounting teams, SEC comment letter trends, specifically around revenue recognition and related disclosure areas. To help us break it all down, I'm joined by my two subject matter experts, Ryan and Mike. They've been neck deep in the latest SEC comment letters and have pulled together insights on what the SEC is focusing on and what comments companies should expect to receive. Ryan, Mike, welcome to the show.
Glad to be here.
Happy to join. Looking forward to the discussion.
So Ryan, let's start with the big picture. You guys obviously sifted through a large data set of SEC comment letters. What stood out to you kind of across the board?
Yeah, in the area of revenue recognition, I'll talk a little bit about how we measure the trends first. So if one were to go to our comment letter website where we give data on the trends, you'll see that there's two ways in which we measure the trends. One is based on absolute number of comments, and then one is based on the relative number of comments. And what do I mean by that? So when we talk about absolute comments, it's just what's the area that's getting the greatest number of comments.
Right.
And then secondly, we also take a look at relative, and that is, think about like a pie chart relative to all of the comments that are out there. Where does revenue recognition fall? So revenue recognition is the top 10. It's the fourth biggest comment area, and it lags behind non-GAAP, MD&A, and segment reporting. And both, though, have revenue recognition has trended up, though, both in absolute number of comments from the prior year, as well as on a relative basis. During 2025, it found itself back and forth with segment reporting. Sometimes it was a third segment reporting. Sometimes took the fourth. So if we were doing this maybe in the spring, we would have been talking about it as the third, but it is the fourth overall.
Yeah, no, I think it's important to highlight. Usually what I try to say is when companies are thinking about just any new standard, any new rule, new standard, right? Whether it changes the segment standard, that obviously is going to cause an increase in the comments. The staff's going to focus on it, but revenue always winds up being at the top of the list. And I know, you see a lot of differences kind of across sectors, like some sectors, not much, but what are we seeing in the sectors?
So by sector, I'd say for pretty much all the sectors, they're generally in the top 5, middle of the pack. A lot of them were 4 or 5. The exception would be the energy and utility sector, where we see that usually in the bottom 10 or sometimes not even in the top 10 in terms of the overall volume of comments. Gotcha. And that's, I think, just due to the nature of the industries there.
Right. So that's a good overview and not really that surprising to me, at least, kind of through when you think about the importance of the revenue, top line of the financial statements, obviously has always been a focus area of the staff's. Mike, you've obviously had many years of experience dealing with some of the more complex technical accounting consultations and revenue. I know you do a lot of presentations, conversations with companies on the topic, and there's always a lot. You always have a treasure trove of experiences to share. And you were here with me about a year ago to talk about the same topic. So any observations about comment letters in this area now as compared to last year?
Yeah, so I would say from a topical perspective, the trends for revenue comments year over year are fairly consistent, nothing particularly earth-shattering. The two biggest areas within the RevRec comments tend to relate to the basic timing and method of revenue recognition and the related revenue policy disclosures. So the staff always has the desire for companies to be more specific and less generic. And very often we have companies out there who basically say, we recognize revenue and control transfers. Okay, that's what the standard would require. And what the comment you will generally receive if your disclosure is like that is, when does control transfer to your specific facts and circumstances? So it's really the when and the why to get to your transactions that the staff is looking for. So that's the number one comment that we see in RevRec. Mm-hmm. What's the timing? And in your policy, are you explaining enough when and why? Again, Ryan mentioned the numbers up. I wouldn't read anything into that. It's not like there's some problematic revenue thing that's being focused on, so I wouldn't worry much about that. Again, it just reflects a continued focus in the area. And then some additional topical themes that we see a lot are on performance obligations, variable consideration, and then revenue disaggregation disclosure. But again, the timing and the policy are definitely the top two.
Yeah. So let's dig a little bit deeper into some of those themes, Mike. And what kinds of questions are the SEC asking on this?
Sure. So let's start with one of those topic areas, which is performance obligations, right? And we always say, you sort of need to get that right in order to get the whole model right. So that's sort of one of the bigger pieces that you want to make sure you get right. So what we see the staff do is, as companies' business models evolve more and more, we'll see the staff ask about performance obligations in those particular cases. So I'll give you an example. So if I'm a software company that's now doing more and more cloud-based offerings and more cloud-based functions to my customers, the staff will ask questions about, all right, is that a new performance obligation? Is it still one type of performance obligation, or now that we have services delivered in different ways, are there two? Or the other thing that we get, in addition to businesses evolving, is companies talking about new offerings. Let's say a company's talking about their new AI-enabled software offering. So that would cause a company or cause the staff to ask, okay, are these AI-enabled features and services new performance obligations or not? So they'll look at, again, companies' business models that are evolving, and then any new types of products that are announced out there. And I use AI as an example because everybody seems to be telling.
Well, they keep asking you about it. I've seen them ask you about that question quite often.
Yeah, so that gets the staff triggering the performance obligation question.
So when we think about that, though, it's like where is the staff getting the information to kind of the source for that, and how are they forming their questions, right? They will look at companies' websites. They'll look at other parts of the relevant documents, so the 10Q or the 10K. Yeah. They'll look at the MD&A. There may be a discussion in there about a new product offering. And oftentimes the discussion or the length may be disproportionate to the amount of revenue that new product is contributing. So oftentimes when a company may get a comment, like Mike suggested, you would see a response sometimes to one way to address that is to say, hey, it's a new offering. It's not material yet. And there are ways, ultimately, we see a lot of comments resolved in this manner by updating, say, the disclosures in the financial statements, in the policies, to use words like, we offer XYZ to a lesser extent, or using words like that to try to put everything in context, because it may be if it's a new offering, it's a new strategic direction, it may get a little bit more airplay in the MD&A. You just want to balance that a little bit in the disclosures, and that's what sometimes that gets fleshed out through the comment process. But there's good ways to address that up front also.
I think you're right. I think even if it's not in the RevRec policy, right, just putting it in the forepart or wherever you're discussing it is kind of half the battle. If you can do that, likely the staff is not going to issue a comment on it. So,
and then in addition to identifying performance obligations, this the guidance requires that you disclose remaining performance obligations. So the staff will often give comments about that disclosure, the the goal is to tell your customer or your investor, hey, I've got performance obligations, so I've been paid and I've got things I have to do. And when is that revenue going to be recognized? So the staff will ask about the bands that you disclose of when they're going to be recognized. How are those determined? And the other thing that they ask comments on is they'll look to see if your contracts are cancelable or you offer refunds. Because if you have a cancelable contract or offer refunds, then you might not actually have a contract yet. And if you put those items in your remaining performance obligations, they actually might not be remaining performance obligations. So they focus on that disclosure when you have cancelability and refunds.
Right. That's another great point. So very, very helpful. So beyond just the identifying performance obligations, what other areas are we seeing, Mike?
Sure. So the next area I would talk about relates to the transaction price. And then here there are two overall themes. One, determining the actual transaction price, and then the use of standalone selling price, SSP, for allocation. So let's start with determining the transaction price. The big focus here is variable consideration. And it sort of makes sense that you would get comments on that. The staff likes in areas of judgment to ask, how are those judgments being made? And so the comments about variable consideration are about what are the estimation techniques? What are you looking at? Especially when refunds and other consideration that's payable to a customer is involved, because there's a lot of estimates that would be made to them. So they're looking for how the company makes those estimates and are they disclosing them properly. The next one is determining the standalone selling price. So SSP, as we say. And SSP is what's used to allocate the consideration between multiple performance obligations. So here, again, the focus is on what are the methods and inputs in determining what SSP is. Now, it's an easier exercise if you sell everything together. And then that's a typical easy comment. Yeah, we sell things together and we look at that information and that's what we disclose and tell the staff. And that's normally an easy process with the staff. The staff has a much keener focus when a company doesn't sell the pieces separately. So let me sort of give you an example. I'm a game company and I'm going to sell a game that's meant to be played online. And so for the price of $60, you get the game. You can play it by yourself in your basement, or you can connect with a whole bunch of other folks online and play. Company sells that right for $60. And so the question is, they determine I've got the game that's sold as one performance obligation, and then the online gaming experience, connectivity, and all that is another. How do we split the $60? And so the staff will ask the question, okay, what are the inputs? What did you look to determine what you might sell it for separately if you sold it for? So now we're talking the land of, some companies are never going to do that. So it's an exercise in, what information did you use to determine what the value split would be if you were selling it separately? And so the staff wants to know whether a company's gone through that thoughtful process.
That's a very good example there. Anything that you wanted to add there?
Yeah, and they don't sometimes just want to know that. They also will look to see whether that's disclosed appropriately. So under ASC 606, there's a requirement to disclose some of the significant judgments and estimates that go into revenue recognition. We do see that a fair amount in variable consideration, and certainly in SSP, where especially in situations where the disclosure might say, we allocate revenue to the performance obligations based upon the standalone selling price. Well, yeah, that's actually what GAAP requires. How do you go about doing that? What are the significant judgments involved? That's where they will ask to understand it, probably in those situations because you haven't told them yet. And after going through that process, trying to kind of flesh that out in the disclosure through the comment process.
Right.
Yeah. And what we also see, which is interesting, is the staff will give those comments and give similar comments to companies in the same industry, because the determination of SSP is very entity specific, how they would go to market. Right. So it's not a one size fits all, But the staff does like to compare and contrast
They
the
do.
ways
They do.
companies do it, just to make sure they're at least following the spirit of what the guidance is. So that's a phenomenon that we see, sort of the group comment letter issuance, as it were.
The other thing that's helpful, I think, too, is especially when you're talking about, say in variable consideration, there's two generally accepted methods. One's called the expected value method. One's called the most likely outcome method. A company may disclose that they generally use the expected value method. And I think it's those words sometimes that
the staff does not like qualifiers.
Qualifiers. So often when I'm reviewing filings, I will ask and just say, hey, what's the purpose of this qualifying word? And sometimes it was just there by accident. It gets removed, or it can be enhanced with disclosure like substantial majority, or in almost all cases, or something like that, to give the reader a sense that that's the majority of the situations. And we may have others, but they're small or immaterial. Though, again, sometimes that gets fleshed out through the comment process as well.
Yeah, it's just listen to to this conversation, your back and forth. It really does highlight, Mike, and kind of you were alluding to this, the importance of benchmarking, right? Looking at, comments that are being issued, listening to these types of podcasts where you can look and say, okay, here are the comments being issued in my industry, in my sector, what should I expect to see? And then carefully crafting your disclosures to make sure that you don't have to get the thing that I always say is, look, it's not a big deal to get comments, right? You're going to get comments from the SEC, but it's always nice to be in a position to wrap them up quickly, right? And be thoughtful about your responses. And I always will say too that, hey, the last thing you want is the SEC to probe, and then they stumble onto something else, right? And so if you have clear disclosures, concise disclosures, and you're addressing all these points you guys are making, I think it's obviously hugely important. So I think benchmarking to other disclosures, looking at other companies, looking at the SEC comment letters is critical. So we have performance obligations, transaction price. I know the next topic, which I'm always excited to hear about, is gross versus net. Mike, take that on for me?
Yeah, sure. Gross versus net, principal versus agent, they're synonymous. And always a area of high comments. And they tend to be high comments because it's very judgmental. Like that's a theme that we'll see in revenue, where there's more judgment that you apply, the staff's going to ask for more comments. So in this scenario, we know gross versus net when there's three parties delivering a good or service. Judgment involves which party controls that good or service right before it goes to the end customer. And oftentimes, one of the key comments that we see is very similar to the revenue recognition timing policy note comment. Companies will often disclose, we record revenue gross because we're acting as the principal. That's all they'll say. And typically in those scenarios, the staff is going to ask, why are you acting as the principal? Why do you control the product before? And it's really looking for a company to articulate. There's lots of indicators of how you might control the good or service before it gets to the customer. So it's really which factors are you relying on to get to that judgment? Now, oftentimes companies, have this zeal to try to articulate every indicator aligns to being the principal. Most of the time, it's not every indicator. Yeah. So, and it doesn't have to be.
Right.
But what you really want to do is you want to say, the comment will be focused on what are you really relying on, and then the disclosure in your comment should be, we are the principal. We're acting as the principal because we control for these reasons.
Right.
And these are the heavy reasons that we rely on as to why we're the principal. So that's probably the biggest comment that they get in the area. The other thing to note, and I think companies sometimes forget this, and it happens more in a good seller than a service, is the answer may drive what presentation in your income statement is. So let me just explain that. So if I'm selling a tangible good, so a vendor makes it, I buy it. I always do this on a podcast. I use air quotes, and I don't know why I use air quotes, but
it helps me. It gives me context.
Buy. I'm putting air quotes around buy, and the reseller will buy the good and then resell it. So if they actually do control it before it goes to the end customer and they are the principal, they've sold the product. Okay. And that would go into their product sale line. If they didn't buy it and it was really they were acting as the agent in getting the good from the vendor to the seller, they're no longer selling a product. Right. They are now doing a selling service commissioned likely for the vendor. And that probably goes in a different line on your income statement than saying it's all in product. So that's like the second thing that you tend to get if you're an agent, but you're an agent in product. It's how much products are there services in that product disclosure. So we'll get that in that sort of gross versus net adjacent.
Yep. Anything that you wanted to add there, Ryan, before we jump to kind of getting into maybe other topics. But I guess the one thing that for me that really stands out thinking about kind of the gross versus net, to your point, it really is taking a step back as you're preparing your disclosures, taking a step back. If you do have new service offerings, you are taking a critical look at what are you actually doing? What are you selling? What is the service you are providing? Because I think as the staff is keen on, like, especially in this case, the income statement, right? That presentation. So I think it's important to be mindful of all the impacts kind of throughout the filing, throughout the document, because certainly that's what the staff will focus on. Yeah,
there are a large number of companies out there that do have revenue streams that are recognized as a principal gross, and also will have revenue streams that are net, like, so-called platform marketplace companies will be one example of that, depending on the circumstances and what they offer. That's why I think, similar to what I said before, we will see comments in this area where the disclosure might say, if these facts exist, we're gross as the principal. If these facts exist, we're net as the agent, without really giving any sense of the magnitude of that and how it impacts the financial statements. For example, you may only, in terms of your throughput or your volume, maybe only 5% of it is as an agent, and the rest of it is as a principal. So trying to give some, and again, it gets fleshed out through the process, but giving some indication of the relative magnitude and what streams, and maybe even considering that from as Mike said, a disaggregated revenue perspective, or how do you present that? That's important to think about. The other thing that's important to mention here too is, even though I would say generally there's a view that principal, because it's higher amount of revenue, that there's a bias when you're saying that you're a principal, for you to get questions in that area about why you're not an agent. I will say there are comments out there from time to time where a company may be disclosing for certain streams that they are an agent and therefore net, and the staff will ask just the other way, why, tell me why you're net and not gross. So I think it goes both ways, and so it's important to be mindful of that. It's not like you just sort of get a pass on your disclosure, say, or your policy because you're net.
Right. I think that's another great point.
And while we don't tend to like to forecast too much, I will tell you, there's a lot more questions these days about companies that are reselling services, right? That has been a trend as far as industry goes, and businesses evolving to a lot more services that they're selling. And oftentimes companies will say, I'm reselling a service. It's an interesting, it's much easier to conceptualize when you resell a product, how you control it. When you resell a service, it's a little bit more difficult, because oftentimes that service may still reside at the vendor.
Right.
And they're involved in the delivery somehow on an ongoing basis. So it's a little trickier. So the expectation is the staff will ask a lot more questions about, again, what are you relying on when you sell a service to say that you control the service that may be delivered by somebody else to that person.
Yeah. So we've already kind of gotten to some of the presentation and disclosure. But Ryan, anything else that you wanted to add on the comments that we're seeing in that space?
Yeah, if I put presentation and disclosure together, I'll cover some of the bigger areas. One is remaining performance obligations. Mike talked about that earlier. We do see comments in that area, especially he mentioned the time bands. We'll see comments that say, hey, we note that you disclose that 25% of your remaining performance obligations will be recognized within the next year and the remainder thereafter. Well, the staff in those cases may look to the standard and ask companies, hey, should there be more specificity, or why is there not more specificity in a time band? Maybe you could tell me about years 1, 2, or 3, right? Mm-hmm. So depending on the situation, there may be a little bit of a negotiation or judgment involved in terms of what's the right bands there, but that's a common one we will see in that area. I mentioned earlier just the overall general principle-based disclosure requirement for judgments and estimates in revenue. So we'll see that come up from time to time. I did want to highlight the disaggregated revenue disclosures as well, though. So ASC 606, the RevRec standard, requires companies to disaggregate revenue by revenue streams based on if they have different factors around like nature, timing, and uncertainty of the cash flows related to that revenue stream. And I will say what I often see, or when a company may get the comment about, hey, why aren't you disaggregating revenue? I often see, say, the first response back will say, well, this is how these are how my executives look at the revenue streams, or this is how the chief operating decision maker of the company, which is borrowed from the segment standard. Yeah. This is how they look at it, and as a result, this is how we've chosen to disaggregate it. Well, that's only one factor under the standard. There's a number of other factors that go into play there in terms of how you've communicated it externally. Are there differences in terms of the timing of the recognition? How does it deal with different economic cycles, perhaps? So when going through that, it's always important ultimately, and in order to get through that process successfully, it's usually important to go through all of those factors with a good analysis as to how you determined the different categories to break it down. It's a highly judgmental area, Mike. I mean, maybe you can comment on it, but it's highly judgmental, and which is why it's kind of ripe for asking, because they're really looking for how the company went through the thought process.
Yeah, one of the things I'll highlight, and Ryan mentioned there's a bunch of clarifications that the standard's trying to get at. And it's like uncertainty and changes in timing, risk, and cash flow, right? And I point on the cash flow ones because sometimes we'll have companies go, oh yeah, here's my changes in cash flow, and they'll show between the customer the gross cash flow changes as their disaggregation. So I paid this incentive and then I got this fee, and the staff is very quick to say, cash flow, net cash flow.
Exactly.
Because you can't explode out the back and forth payments with
as much as you want to.
As much as you want to show that. The staff is very quick to say, if you can't present that as its own revenue gross on the income statement, you can't do it in
the footnotes.
In the footnotes. And companies will point to, yes, but that's a change in cash flow. That's what the 606 is talking about. We remind them, net cash flow. With your customer.
That's a great point. Yeah.
The other thing I wanted to mention here is there's a requirement in Article 5 of Regulation SX, to the extent it's applicable to a company, and a large percentage of companies Article 5 is going to be applicable to. It requires the breakdown of revenue between products and services. And in certain industries, we've seen where that can be sometimes challenging, or you get comments in that area. So for example, take a software company that maybe delivers its offerings in two ways. It provides licenses and delivers licenses and code to companies to run on their own infrastructure. And then they may also provide that software through a software as a service or a SaaS-based offering, completely hosted. Well, generally speaking, the staff through the comment letter process would say that those those licenses that are going to be delivered on the customer's premises, usually they're point in time recognition, and they'll say, well, that the staff will say that's akin to a product revenue, and they will say, while your software as a service revenue is more aligned with the service, and therefore you shouldn't combine them on the same line. You should break them out. We do see, and I've seen an uptick over the course of the last year, we do see comments in that area where the staff is clearly articulating that view through the comment process and asking companies how they considered it, because they'll see them lump it all, say, in a line item called subscription or something like that, and they'll ask about how 503 was considered. Sometimes it's maybe not material. It's not greater than 10%, which is the threshold in the rule, but that comes up.
Yeah, I think what that highlights, right, is that you have 503 of SX, an SEC rule that was written well prior to the standard, right? And so when you're looking at how you're applying it or whatever, the staff certainly is going to take the view of, hey, look, we're going to interpret how we think 503 of SX should look versus, okay, here's what GAAP requires, what ASC 606 requires. But Mike, you were, as Ryan was kind of providing that explanation, you're kind of like, yeah, I'm not really a big fan. I wanted to kind of get your reaction.
Say I was a fan. I didn't say I was a fan of it.
I didn't say that. I didn't say you were, but you both kind of had looks on your faces of like, well,
is it fit for purpose?
Yes. Yeah.
Right, because it's product service. And I think, oftentimes you get the feel that the staff views it as a proxy for point-in-time overtime.
Yeah.
Right.
And it's like, well, actually, take licenses aside, there are services that are point in time and there are products that are overtime. So it's not as easy as that. So, if you have those scenarios, then the question always gets to, is there some disclosure about the point in time overtime? Maybe that should be a revenue disaggregation disclosure or something to that effect. But, there's always been a struggle about what do you do with licenses.
Yeah.
And even when you have, in the software world, post-customer contract support, if it's largely upgrades, well, aren't upgrades another form of license and product? And so shouldn't that be in the same line? So it's very
squishy.
Well, it says products and services, and there's always this question, well, what about licenses? Right. What do you do with them? So we've seen a lot of different things, and it's just a matter of when you get the comment, just articulating why you group them together and be as transparent as you can be.
I think that's great advice. The transparency is key.
I think companies will talk about how they go to market and why they look at it similar to that may not always carry the day, but it does help.
There's a basis at least.
There's a basis in terms of how they.
Right.
How they
it's funny you picked up on my face as we were going through the discussion. Yeah, because there are times when you'll have companies that are frustrated because, I wish I would just fix that and add licenses in there. I'm like, well, be careful what you wish for on that one, because I don't know if that's a good thing or a bad thing.
Exactly. Right.
Exactly. Yeah.
That's right. I don't know if you necessarily want licenses in there, because some of the comments I have seen, it says, well, we notice you have license. You should have a separate line called licenses.
So, thanks. Love it.
Right.
But I just wanted to highlight it because it is. Yes,
no, I think it's
a dated rule, but it comes up
a lot. Yeah, no, it does. It does. So I want to kind of get to the next part of this here, and it really is that we talked a lot about process. We've talked a lot about kind of providing advice about how to engage with the staff. But Ryan, can you talk a little bit about just kind of what we're seeing? I mean, are we seeing amendments to filings? Are we seeing things wrapped up quickly? Like generally, broadly, what are we seeing in that kind of engagement with the staff?
Yeah, so the vast majority of comments are usually resolved through a little bit of clarification, a commitment to update or revise the disclosure going forward. We don't. It's. I'd say it's pretty rare where after going through that process, you're actually identifying that there's misstatements that need to be addressed. Right. Most of the time, it's. Oftentimes the staff might be asking, as we've talked about, an immaterial revenue stream. So sometimes it's just educating the staff through the process that, hey, good question, but this is immaterial for us, and it's really not going to really not going to matter at this point in time either way, and we'll continue to monitor it. So we do mostly see, I would say most of them get resolved through a clarification process.
Yeah, I think in a lot of cases, again, where you have business models that evolve and new products, there's that newness where the staff is trying to understand, okay, how's the industry dealing with this evolved business or this new product? We'll ask comments, not to say they're wrong, just to understand the lay of the land, and so that they know what models are out there and how they should be looking at this going forward.
Yeah. All right. So, guys, really do appreciate you taking the time. I did want to close though with a question for each of you, and I know you'll both be able to come up with a response pretty quickly. I imagine. As you think about companies that are getting close to year end, any takeaways, any suggestions, recommendations that you have for preparers, to the listeners, on what they should be thinking about in this space for this topic, and when they're preparing their year end 10Ks filings.
Yeah, sure. We talked about it a little bit during this podcast, but I would say make sure as you're thinking about your revenue disclosures and trying to address potential comments that could come, being very mindful of what you are disclosing in other parts of your document or externally on your website, press releases, et cetera. Because I think that's the source for a lot of the comments. And so I think it's important for those who are responsible for updating and refreshing the revenue disclosures to make sure that they're doing that in the context of the bigger posture of the company and what they have disclosed publicly, because oftentimes that's where the staff's they'll go through the front of the document, the MD&A, the business section, and I'm certain they'll just circle parts of this and say, I didn't see this. Yep. That's discussed. I saw one recently where they were talking about a customer reward program in the front. But you go to the policy note and there's no discussion of variable consideration. Now, maybe there's a valid reason for that, but those are the types of things that I think are important for those who are responsible for the policy drafting to make sure that they've thought through that. So as you approach your end, I think it's important to consider that. Mike?
Yeah, and then the internal alignment. So when you're looking at your revenue disclosures, well, what's your segment disclosures? And are those disclosing different things? So not just elsewhere where they're speaking externally about what they do, the staff continually wants that consistency and alignment. So just making sure you understand whether you're contradicting, you have contradicting disclosures between revenue policy, segments, et cetera.
Great advice. Appreciate the both of you joining me today. Thank you.
Oh, good to be here.
Thanks.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.